Great to be here. Thanks for having me, Mike.
Sure thing. I like to dial back to just about a month ago, right before the previous CPI report, right? This is July 12th. Yeah, the S&P 500 within 1% of where it is right now. The 10-year Treasury yield's 4%. That's where it is right now. When we got that tame inflation number, it was a bit of a kickstart for that late July rally. We added a few percent. Now we've given it back. What is the status right now in your mind of the soft landing economic scenario and how much of that the market can still benefit from or potentially have a downside surprise about?
Well, look, I think that the market learned some pretty important information from that last inflation report from June that we saw in July, which was that the disinflationary process has moved from an early stage to a more stable one. That's one where even if the Fed isn't done hiking, the terminal rate is in sight and investors can be excited about the potential for a soft landing. Now, I think it's a little bit of a false start, but one that could last for a couple of months still, because until unemployment claims start durably rising, that narrative is likely to be the one that dominates. Now, do we see significant equity market upside from here? It would have to come from a broadening of performance from the laggards starting to catch up. So we may be in a bit of a range-bound and volatile market, one where stock pickers have a bit of an advantage.
This latest rise in Treasury yields, it's been a global rise in yields, actually. What do you read into it in terms of, are we just pricing out or pushing away the prospect of recession for now? Is it just about rebuilding inflation expectations or something else entirely, maybe just Treasury supply that's on the way as well?
It's about something else entirely. There are a couple of reasons why long yields can rise durably. It's either because the path of the Fed funds rate or global interest rates change because growth is looking different in the future, or because inflation expectations change, or because of supply and demand factors. And what we've seen over the past week or so is a lot of supply and demand factors pushing and pulling on the long end of the curve. That includes changes in the Bank of Japan's policy. It includes the Treasury auctions that you mentioned, increasing supply. And it also, of course, includes the downgrade to U.S. credit ratings that we saw last week. Now, a couple of really important takeaways for investors on this point. First is that it matters very much why the Treasury yields are moving higher. If it were because of growth expectations moving higher, then it could happen sustainably. But because it's in these supply demand factors, we expect that to extract more volatility in the long end of the curve. And for that reason, the second thing really important for investors to keep in mind is that as investors have been thinking about adding duration, this dynamic with the curve being so inverted makes us less certain about that. We're staying short duration in credit and adding duration only in the municipal part of the curve where we see a little bit more benefit from taking that duration risk.
One thing that the yield move has not really been about, though, is the market repricing the path of Fed policy, it seems anyway, because the short end of the curve has been very stable. Today, we did have more Fed speakers out there, I guess, communicating kind of a measured stance on maybe we'll need to do some more tightening, but as it stands now, probably not yet. Market seems comfortable with that. Is that something that can, I guess, underpin further financial market stability, keep yields in their range, and therefore, the stock market can benefit? That auction, I think it was the 3-year note auction today, very well received. That might be an indication that supply can be absorbed.
Yeah, look, I think it's really interesting that we've benefited in the markets from several quarters now of essentially a pivot rally. The idea that even if the Fed might have a hike or even two left in its arsenal, that we're close to the end of the rate hiking cycle. We're close to the terminal rate. And that pivot rally, it has historically and certainly in this case been an opportunity for investors to add value. Again, it's only when the pivot starts to turn into, oh no, we might be entering a recession, that the equity markets react to recession in real time. And so the fact that investors are not so worried about the Fed funds rate and its trajectory at this point has been very constructive for equity markets.
Yeah, and it is a fair point that the market doesn't always, see the tougher times coming from a long distance away. So we have to keep that in mind as we deal with the leads and lags of this cycle.